Today we're being joined by James Burrell, CEO of the Vere Group, that is going to discuss with us his view on the UK hotel market for 2024. Thank you, James, for joining us. It's a pleasure to have you today.
Thank you. Thank you for the invitation.
My pleasure. We're launching our new publication, Business Outlook. So we wanted to have a bit of your view as CEO of the Vere Hotels on what has been happening in 2023, but most importantly, what you expect to see in 2024.
So pleasingly, 2023 ended well. And actually we saw a growing momentum, I would say, through the course of 2023 across all of our markets, in fact, including the leisure, corporate, meeting and event, and overnight, longer extended stay business. So it's overall has been a really positive start to 2024 as well, but also a positive end to 2023.
I think the big question, I think that's why it was particularly interesting to have you today, and a big miss is that there has been a real slowdown in meetings and events since obviously the Zoom era and all these virtual meetings. So but I think that's actually not really what's happening on your side. So what have you really seen in the meeting and events market?
It's really interesting that there is still the thought out there that the meeting and event market is not performing well. Because in actual fact, the proof of 23 and even what we started seeing back in 2022 is quite different. So if you cast your mind back too far, I would understand the skepticism of whether the Zoom era would prevail. What we're finding actually is that corporate market really wants to get back together. They want to get their people back into the same room, meeting together, be it for training or a social event or delivering a message to their broader business. And that could be either a day meeting or it could be an overnight for a day or two. But I think actually there is as much that we're seeing around commentary in the market, the likes of Morgan Stanley, for example, who in the end of Q4 issued a really interesting report, which actually pointed to there being good growth in that corporate meeting and event market. So they're quoting somewhere in the region of 8%, for example, growth in spend in that particular segment. That's a global market, 8 billion of spend, I think they were canvassing. But that I took as a real positive that actually what we're seeing is also being reflected in the broader market.
That's good, because I think that's, again, something we're being asked all the time, and it's good to see that it is back. And have you seen differences between, I think, what you call different verticals? When we had a chat, I think this is what's interesting, is not all segments are and all sectors are reacting the same. So what has been the good verticals and the not so good verticals for you?
It is interesting, and we work in a vertical, our clients, we put into those verticals that you reference. And look, there are multitudes of those, anything from automotive to accounting to banking and finance, insurance, media even. I wouldn't say there is a particular trend from one vertical to another, but what we're definitely seeing, and we saw it in the latter part of 2023, is where there were clients who used to be regular users of a De Vere hotel and did stop, of course they did during COVID, and maybe went virtual for their meetings. Not everyone decided to come back as soon as the other. So it may be a vertical driven, industry driven. I don't think so, actually. I think it was appetite for risk within a particular corporate to get their people back together in the same room and around the table. But even those that all the way through until Q4 of 2023 had not met together have then started to, and of course once you start to, that then I think then starts the trend again. So they value the benefit of being in the same room, of training together, of being face to face, and maybe not even just doing the work side of things. They spend as much time then doing some team building or having a dinner or having a drinks reception.
And is that something you've seen, the type of event or what people want to do? The outdoor is quite important, I think, now. What are the key trends you've seen on that? What people now, what's really important for them? Because maybe they're not as much in the office, and actually being together is really important, and maybe spending more time, longer time, more residential. So what has been the key trend you've seen on that side for you?
Yeah, look, there's lots of points you've raised there that we're seeing. So where, for example, corporates, businesses are not getting their teams back together into the office as regularly as they used to, sometimes coming on a 2 or 3 day event is a really nice way of doing that, particularly for those that joined a business through COVID and so didn't manage to meet their colleagues in those early years. Getting everyone together in the same room has proved to be really valuable. So there is that whole interpersonal connection side of this that is so important. But equally, and you're right, maybe in 2022 and the earlier part of 2023, we perhaps saw more of that social aspect. So people using the great outdoors, as we call it at De Vere, because with big grounds and lots of space.
How is business on the books looking on that side for next year? Do you have a lot of bookings already? And do you think 2024 will be as good as 2023?
I reference this great report, I love talking about it, the Morgan Stanley report. It is estimating 8% growth next year on corporate travel spend. That's a global number. But then what was interesting, there was a very interesting A&M, Alvarez and Marcel did a great hotel conference in Q4. And the leaders of some of the big global hotel groups, so the CEO of IHG, the CEO of Marriott, people from Hilton, were all in the room. And actually the general consensus there was positive for the corporate event market. So anywhere in the sort of low to mid single digit growth in terms of their business on the books for 2024, going in from Q4 23. So that sort of trend, that feels positive. And I think in some places actually is surprising people how positive it is.
Yeah, I think that's probably the side where after we can go to the leisure side, which might be a bit different, but corporate, as we can see from where it was in 2019, he hasn't fully recovered yet. So they're going to be still growth to be had in 2024. And that is positive as we because it's clearly going to impact on RevPAR.
I'm just going to come back to that point you mentioned about corporate not being back to where it was pre-COVID. We're not seeing that, actually. We're seeing it in a different way. The makeup and the client base might be different. But in terms of absolute revenues comparing back to pre-COVID now, we're above where we were. In fact, by mid-2023, we were trending above the history. But it's coming not always in the same place. So for example, I'll give you a good example that maybe explains some of it. We used to have clients who would fly in lots of people from overseas and use us as a hub, UK hub for training. There's a bit less of that. It's starting again, somewhat more slowly, but we're very much relying on a domestic UK demand. And there is more than enough of that, partly ESG driven, potentially. Well, I'm sure we'll talk more about that later. So I'll save that thought for later. But it's a more buoyant market, I think, than some in the industry are suggesting.
On the leisure side of things, which is obviously your other business and during the weekends, how had that behaved last year and where do you see that going in 2024?
So leisure means multiple things for us.
Yeah.
In De Vere, it could be someone coming for a family celebration weekend. It could be a wedding. It could be a golf type event. So lots of different things that we do in De Vere that's leisure driven. Clearly, there were some peaks in, for example, the wedding market. Coming out of the pandemic, there was a big pent-up demand, obviously, and that did impact us very positively in the 2022 year, a bit less so in 2023. It's probably right to be a bit more cautious in 2024 about the consumer wallet. There are obvious challenges impacting everybody, and so we're not going in expecting to see the same levels of growth in that leisure spending. We're still expecting growth, but it won't be the high single digit, low double digit type growth that we've seen in recent years.
And have you seen a lot of development on families? Because I think you mentioned that, and I think it's part of your strategy as well to have a bit more focus on that segment, which I think currently is not well catered for. And that's where Airbnb and some of the alternative accommodation has picked up some of that market. So I know you've done some things at De Vere on that.
It's a great market for us in July and August over the Easter period, the half-term weeks, where our sort of core corporate business may be a bit softer. But what we're doing actually is to create more family type bedrooms. So whether it is at even somewhere like De Vere Horsley Estate in the Surrey Hills. We're creating family rooms there so that we're more appealing to that family market. Somewhere like De Vere Cotswold Water Park, which already has got great opportunity, and what's interesting there is you're seeing families coming together. So you will maybe have a 1 or 2 bed apartment there where you and your children could go, but you can also then have your family or your siblings come along, be with you on your holiday, but stay separately. I think generally as an industry, actually, we had to adapt, particularly coming out of the pandemic with that awful staycation term. But that is, that's what kind of kept the business going well through those earlier months coming out of the COVID period.
So overall, if we try to have a bit of a prediction on where we see RevPAR going in 2024, where do you think it's all going?
You look at what's happened over the last couple of years. 2022 was very much a story about rate. So rate generally across the industry grew very strongly. 2023 was more about occupancy, and that may be more to do with De Vere. We actually held occupancy back slightly in 2022, just as we started to rebuild the business from an employment point of view and bringing the team back together. So 23 was much more about occupancy when we look at our overall RevPAR growth. I think 24, therefore, we're assuming will be a blend of both. And again, industry commentary is saying somewhere in the low single digit, maybe mid 4-5% type ARR growth. I think that would not be bad, but even then you're only keeping up with inflation.
Yeah.
Similarly, for occupancy, actually we still have some way to go, we think, from an occupancy point of view. So blended, if you put those things together, you may be in high single digit, low double digit RevPAR growth, which I think in the current climate would be a really good outcome.
So now that we've covered a bit the top line, basically, of the P&L, let's go a bit more on the more interesting topics of cost and recruitment, payroll. How is that going? Is that still a very big topic for the industry? Has that normalized? What's your view on it for De Vere?
The expectation is that for 2024, we're in a much more normal state when it comes to hiring. Pay is somewhat determined, obviously, by in Q4, the national living wage increase of 10%. That was significant. But look, there's a positive to that. It does mean that the team is all being well compensated for the hard work that they do and being looked after, and that's important. To continue attracting people into the industry, you have to offer that. But certainly our view would be at the moment we're not. Certainly the most recent of our vacancy reports is not showing anywhere near the level of vacancies that we had if I looked back 12 months ago.
Yeah, and I think that's what I'm getting as well as a feel. Every discussion we used to have, it will start with staffing. Yeah. And I'm not saying it's easy, and we know will always remain a challenging industry to find staff and keep them on, and because it's really difficult. But I think that has normalized as well. And as you say, you need to be more flexible also when you're recruiting, provide them more with additional benefits, I think you said. So what would be the kind of things you think are important right now for staff to retain them?
Look, in some cases, it's about flexibility, actually. So not everyone is able to work on a full-time basis. And actually, there is I would say, more of a culture that people want to not pick and choose, because that doesn't work so well in our industry, but to have perhaps a bigger pool of casual base so that you're able to try and accommodate people if they want to swap shifts or move from a Friday night to a Monday, for example. So I think that we find is a very important way of helping people and helping attract, particularly the younger generation, into the industry. But on top of that, there's a lot that the senior team have done to make everyone feel part of the De Vere team, part of the family. So lots more what we call surprise and delight type events. Every month there'll be something that the team do, and those are different. That's all actually up to the general manager and their teams to work out what that is. But it makes everyone feel like a valued part of the De Vere family, and that actually, from a retention point of view, can be really worthwhile.
And then if we move down another key topic in the cost lines, we have the utilities.
Yes.
So it's still probably quite uncertain where we're going. But again, that has kind of stabilized. So where are we on utilities? And what's most important, I think that has changed behavior within your company.
Yes.
So that is probably the key learning, again, from COVID and the pandemic, that people can make efforts as well.
Yeah.
So what have you done on your side?
You're right, it has stabilized. But what's interesting, we get weekly updates on pricing and issues that are impacting supply or demand. The price can still be quite volatile. So I suspect we, like most, have locked in that pricing to different levels in 2024. But we watch it weekly so that we are, if ever we are advised that there is some spike coming, we can very quickly react and lock in for a longer period of time. To your other point about behavior, and this is sort of wraps up into the whole ESG topic, there are so many things, again, that the hotels really are doing. You know, they all have an ESG committee. We have an ESG ambassador, as we call them, someone from within the organization who put their hand up and said, I'm really fascinated and interested in this and I want to make a difference. So they now spend, you know, a lot of their week focusing on ESG related topics. So it's somewhat about the cost saving. And obviously from a P&L owner point of view, it is about the cost saving, but it is as much about reducing consumption. And that's become something in our everyday lives is very normal now to do that.
Again, ESG, because that's obviously a key topic always for everybody. It's now, I think, top of the agenda finally. Not fully for all sorts. I think depending if you're more a private owner or if you're more institutional, you don't have as many requirements or expectations, but that's coming through slowly. So what has been the key part of your strategy on that front, and for your shareholders, what have you been focusing on?
The ESG committees that we have within the hotel bring their ideas, and then we share those ideas across all of the portfolio. So one idea, I mean, there's some such low-hanging fruit, actually. When you look back, swimming pools, for example, most four-star hotels have a big swimming pool. We didn't have covers on those swimming pools. So, you know, there's probably 12 hours a day where no one's using it. You put a cover on, and that helps then reduce the amount of heating that needs to go into keeping that pool warm. Some really basic things that probably we could all have been doing better. More meters around the property so that you measure your usage and consumption of different parts of the property. And every morning, chief engineers will now look at those usage statistics to make sure that we're keeping consumption lower. So it somewhat starts from within. Starwood Capital, our shareholder, has got within its portfolio of brands some really leading sort of edge branding and hotels around, for example, the One Hotel. So we're able to take some learnings from them, which is fantastic. We really appreciate that. But then also the customer base is changing its behavior, interestingly. So I'll give you a good example of a big corporate will have people coming from all over the UK to one of our properties. In the old days, most of those 200 or 300 people would drive to that property. Actually, what they mandate now is you have to use train. So being well positioned as we are around train stations, it means that we will then put on buses that will go back and forth to the train station, but you're therefore reducing all the carbon footprint of people traveling by car to your hotel.
Another topic that we need to discuss a bit probably is investment and capex, because what we're finding is a lot of people have not maybe, or a lot of owners have not invested in the properties over the last few years, despite because they were busy and because the environment was better than they expected. So what are you planning in terms of investment and capex to the property?
Look, we've been very fortunate with Starwood Capital as an owner who understands the value of continuing to invest into the real estate. And I think in part, well, it has helped us to continue growing that room rate probably above market. Because you're absolutely right. If you've been unfortunate in terms of capital structure or investment over recent years, where others in your comp set have not, I think you may struggle more so in 24 and 25. That's a given. I mean, that's the same in any. But we are an industry that has a cycle. So we were fortunate that even through the cycle, we were, for example, finishing bedroom refurbishments through COVID at Beaumont Estate in Windsor. We did the same at Tortworth near Bristol. So we've done a lot still on bedroom refurbishment, but that's what I call the development capex, the return on capital type capex. But at the same time, we have probably 4% or so going through the P&L in terms of maintenance P&L, either people or cost. But on top of that, also the FF&E reserve. So there's another 4% that goes in FF&E reserve. So that's 8% of revenue in aggregate from a cash point of view that's going through FF&E. So it's important to us as a brand, and I think for any of the brands to maintain what that brand standard is, you have to keep investing into your real estate. And it's in some cases quite basic things, carpets. So we've just recarpeted all of the Cotswold Water Park as an example. Shower curtains. Who still has shower curtains? They're gone. I mean, that was always a pet hate. So there's some really simple things like that, which make the customer experience so much better.
One of the key things we think we're going to see is more stock coming to market finally, which was a bit lacking over the last 12 months. And that is going to be linked to a lot of refinancing that people have to go through. And at some point, that will open sometimes difficult discussions with your lenders. And in some cases, as you say, it'll turn probably into a distress situation, which again, we've seen quite a pickup in the back end of last year. So we see that continuing in the next few months and probably accelerating to some extent. The other thing to keep into account, because that has been a massive impact on the market, is all the stock that has come out of the market in the UK. So first, a lot of hotels that never reopened post-COVID, and that's probably around 4% of the overall supply that gone out of the market. And then you had all the government contracts, which is another probably 5% of the market. So overall, there has been a lot of hotels not reopening or used for a new demand, which was basically government-led type of contracts. But as those are being phased out, it's most likely that they might impact first on performance in some extent, but most importantly, those assets that have been now probably in bad condition after so much use, there will be a lot of discussion at some point with owners thinking, what do I do now? And probably I should sell. And so I think we're going to see a lot more activity in 2024. And I think we'll have more opportunity to discuss opportunities in the next few months. So thank you so much, James, for your time. It's been a pleasure.
You're welcome. It's been good to be here.
Best of luck for 2024.
And to you.
Thank you.
Thank you.